Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors. September 18th, just after the close. September already, halfway through. Another dose of volatility this week. If you're looking at headlines, probably you may think the volatility or the drawdown was worse than it was. We're looking at, S&P down 0.5 point for the week, NASDAQ 1.25 or so, NASDAQ 100. But the broader market, Russell 2000 up 2.5% on the week. So what is that telling us? Remember, we don't want to do these videos just to recite what the markets did during the week. You can find that in multiple places. These videos are to help our clients and our friends get an idea of what we're seeing week to week, which leads to month in the markets, both equity and fixed income. We've been discussing now for 4 or 5 weeks that strong bid in the heavy, what we call the heavies, heavy industries, chemicals, transports, basic materials, bid again nicely this week. Now, those aren't the type of sectors that garner a lot of attention. Tech obviously does. It's tremendous in terms of its growth rate, from Microsoft down to startups. Very exciting, a lot of pizzazz in that area. But pay attention to some of these normally overlooked industries. Chemicals are going out at 52-week highs here. Basic materials bid very strongly. If they're not part of your portfolio, at least start to look at them. Where we make mistakes as traders and investors month to month, year to year, is when we get locked in to one type of trade. Whether that's tech or healthcare or biotech, tends to be tech these days. Why? Tech's 33% of the S&P 500, garners a lot of attention. It sometimes takes a fight to look away from a sector that you're comfortable with. I mention that because when we look at some of these chemical names, when we look at some of these basic material names, we're finding names trading at 10, 12, 14 times next year's earnings, paying you a slug of dividends. That may be a spot that deserves some attention in your portfolio. Doesn't mean you reallocate your entire portfolio, but you look at new names that might help us as traders, as investors, take that next leg up in the market. Very healthy what we're seeing in large cap, and large cap tech, but large cap in general. Very healthy to see this pullback. We can't just keep marching forward. We saw that late August peak. We've been in distribution since then. A lot of supply. Insider selling has spiked. That supply into the market has spiked in large cap and in tech. We see the Snowflake IPO this week. Think about the selling that takes place in other names, in other tech names by traders to create liquidity to buy a hot new IPO. Now multiply that IPO by a large docket of IPOs that we've seen. So the market will never change. It's supply and demand. When a sector or industry has run to the point where there's not enough demand left to move it higher and supply takes over, it retrenches, recalculates. That's what we're seeing in large cap right now. In terms of what we did this week in the portfolio, US ETF, we added to our financial position. IYF is an ETF that we added to. It's now an 8% position. Our financials overall all are 13, 14% of the portfolio. Why do we do that? We find it very interesting that rates have stopped dropping. Financials need that spread business. They need higher rates to perform. May sound strange that they need higher rates. You would think lower rates, more mortgages. Banks are a spread business. Broker-dealers are a spread business. Need those higher rates. Maybe that 70 basis point number on the 10-year, which has been very sticky, maybe that's a jumping off point where rates start to rise. Financials are telling us that a little bit. You know, they're trading dry, they're trading sticky. Next week we'll be looking to put some money to work in the tactical portfolio in some really nice names that have been hit 10, 15, 20%. So I'm looking forward to sharing that with you next week. Have a great weekend. See you Friday.